Hello everyone, welcome back to our channel. Today we have an exciting topic to dive into.
You ever look at a stock chart and just wonder, why? Why does the price seem to hit an invisible wall and just stop? Or why does it fall to a certain point and then, almost like magic, bounce right back up? Well, I'm here to tell you it's not magic. It's a blueprint. And together, we're going to decode the market's hidden structure.
So that's the big question, isn't it? It looks so chaotic, totally random. But what if I told you there are these predictable zones where reversals tend to happen? And they're not driven by some complex secret, but by the simple, powerful forces of human psychology and basic economics. And really, that's the key. Forget all the complicated algorithms for a second. At its very core, these market movements boil down to a really simple analogy. A price that's bouncing between a floor it just can't seem to break through, and a ceiling it can't seem to rise above. Okay, so what exactly are these invisible forces that are creating these floors and ceilings? Well, it's pretty much the oldest story in economics. It's that constant tug of war between supply and demand.
Let's start with the floor, which in the trading world we call support. So imagine a stock is falling. As that price gets cheaper and cheaper, more buyers start to get interested. They see a bargain. At a certain point, that's our support level, so many buyers jump in that their demand completely overwhelms all the selling pressure. The sellers run out of steam, and the price, well, it has nowhere to go but up.
All right, so we get what they are. But the real trick is, how do you actually find these zones on a chart? How do you separate a real solid level from just, random market noise? And this slide just lays it all out perfectly. You've got two sides of the very same coin. Support is the floor, right? That's where demand wins the battle and the price bounces up. Resistance is the ceiling. It's the mirror opposite. It's where supply, or the number of sellers, floods the market and pushes the price right back down. Same concept, just working in opposite directions. This is the million-dollar question, isn't it? I mean, anyone can draw a line on a chart where the price bounced one time. But a single bounce? That could just be a fluke. A real tradable level? Well, it needs to prove itself. So how does it do that? By doing it again. See, the unofficial rule that traders live by is called the rule of two. A price level is only really considered a confirmed support or resistance zone after the price has tested it, reversed, and then come all the way back to test and reverse from that exact same level a second time. That second touch, that's the confirmation, that's the signal. So, you've done the work, you found a confirmed level. Now what? Because let's be honest, identifying the level is one thing. Having a concrete plan to actually act on it, that's a whole other ballgame. Let's break down how all this theory turns into real-world action. Let's make this super practical. Imagine a stock, we'll just call it Innovate Corp. It falls to $100 and bounces. Okay, that's step one. We've identified potential support. A week later, it falls back to 100 and bounces again. That's step two, the crucial confirmation. It's only now that you'd even consider step three, executing an entry. And the moment you do, you're already thinking about step four, planning your exit. And what's so fascinating about this is the incredible discipline it takes. This piece of trader wisdom is pure gold. Think about our Innovate Corp example. The temptation to jump in on that first $100 bounce is huge, right? You're hoping you've caught the exact bottom. But the pros, they wait. They let the market prove to them that the floor is solid before they risk a single dime. So for Innovate Corp, where would you actually plan to take your profits? Well, a really smart, data-driven way to do it is to just look left on the chart. Let's say before this whole drop, the stock had peaked at $115. Well, that old peak is now a natural candidate to become a new resistance level. It gives you a logical, predefined exit map. We've talked about making money, which is great. But now we need to talk about the most important part of this whole thing, not losing it. Seriously, managing your risk is what separates the professionals from the amateurs, and it is all about protecting your capital. And that goes for trading from the ceiling, too. Let's say Innovate Corp actually reaches our $115 target and gets rejected. That's where you'd exit your winning trade. Or if it gets rejected twice, you might even place a short bet, betting that the price is going to fall. But again, you have to wait for that confirmed rejection, that clear sign that the sellers are now in control. But what if you're wrong? What happens if the floor breaks or the ceiling just shatters?
This is where this single most important tool in any trader's arsenal comes into play, the stop loss. Think of it as your pre-planned escape hatch. It's the exact point where you say, you know what, my analysis was wrong, and I'm getting out now, before a small loss turns into a disaster. Okay, so the crucial detail here is where you actually place it. If you're shorting Innovate Corp at that $115 ceiling, you don't put your stop loss right at 115, you place it slightly above it, maybe at 116. That little buffer gives the trade some room to breathe, and really importantly, it protects you from those little false breakouts that can trick you. And this really just sums up the psychology behind it all perfectly. Your stop loss isn't just some price on a screen. It's the official invalidation point for your entire trade idea. If Innovate Corp breaks decisively through that 115 ceiling, your thesis that it would fall is simply wrong. The market has proven it. So the only logical, rational thing to do is accept it, exit the trade, and save your capital for the next opportunity. So the next time you look at a chart, try not to see just a jagged, random line. Look for the battles. Look for the points where the buyers made a stand or where the sellers drew a line in the sand. Because once you can see the structure, you stop seeing chaos and you start seeing the blueprint.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.